Hi, this is James Shrug with the market wrap for Tuesday, August the 16th. It was a pretty interesting day today in that European developments had a significant impact right around the Northern Hemisphere stock markets, actually preventing what would otherwise have been possibly a positive day on the US market from actually happening, and as we speak, the Dow's actually down quite sharply. I'll run through the sequence of events. So it started early in the London session with very weak German economic growth numbers for the second quarter. The economy expanded just 0.1%, down from a 1.3% growth rate in the second quarter. That was actually revised down from 1.5%. The market had been looking for a number closer to around 0.5%, and that meant that expectations for the European economic growth figures for the second quarter, which came out later in the day, were pulled back quite sharply. In the event, European GDP growth was 0.2% in the quarter from 0.8% in the first quarter. This was all pretty disappointing for markets, the concern being that Germany's been the engine of European growth. And if Germany's slowing down, then potentially the risk is that the European economy might struggle going forward. We actually question that in the short term because there's been a significant build-up of orders in Germany, very strong orders growth over the last few months that actually hasn't been matched by industrial production. So there's still an orders backlog that needs to be worked through, which should mean that the German economy keeps ticking over the remainder of this year at least. Make no mistake, we still think there will be a recession in Europe next year, but that's going to happen after the European sovereign debt issue really blows up with debt restructures or defaults from a range of smaller European economies now our baseline forecast, with flow-on negative implications for the banking sector in Europe, for lending, economic activity and so on. But that's going to be a story for another day down the track. But on that point, we had a press conference from Angela Merkel and Nicolas Sarkozy where they came up with actually a range of brilliant ideas. Basically a financial transactions levy is going to be imposed, or they're going to propose it at least, to come in soon. They talked about tighter budget deficit rules, and they're going to set up a Eurozone Economic Council headed by the current EU President Van Rompuy. So basically, more rules, more taxes, more bureaucracy. That's the European sovereign debt issue sorted. Not. There was some discussion actually of these proposed European-wide bonds guaranteed by all members of the Euro. Sarkozy said that he could possibly one day imagine it happening, but only when there's far greater integration between the European economies in terms of fiscal policy and so on. So really nothing concrete at all emerged from that. So it was the weak economic numbers out of Germany and Europe, and then the press conference, which really didn't deliver anything and showed yet again that European policymakers really don't have any idea of what to do about the sovereign debt crisis. It was those two developments that really pushed down stock markets today. And on that, as I speak, it's 6:25 in London. We've got the Dow down 1.4%. It's at 11,317. And European markets mostly down, but only slightly so. French market's down 0.25%, the German market down just under 0.5%, and the FTSE managed to eke out a 0.1% gain in the last minute of trade. The irony being that European markets actually performed relatively less badly today because there was some decent US economic data. We saw a 0.9% increase in industrial production because of auto output ramping up after a few months of weakness on the auto side because of problems getting Japanese parts in. We saw some housing figures, housing starts and permits. Yes, they weren't as weak as expected, still declines, but basically the bottom line there is housing is like only something like a fifth of the size it was at the peak of the boom. It doesn't matter what housing numbers do in the US, if they go up 10%, down 10%, it really makes very little difference in terms of economic activity because that sector is just so damn tiny now. Also on the data front, in the UK, another CPI figure well above target, 4.4%. Another letter had to be written by the Bank of England governor to the Chancellor, an open letter explaining why. Same old thing, we've seen it many times now. It's temporary factors holding up inflation. when these temporary factors such as VAT hikes and so on drop out of the numbers and the very wide degree of spare capacity in the UK economy really impacts, we're going to see inflation back at the 2% target in the medium term. So that's really about it, I think, in terms of the, sort of the major events of the day. Just glancing through my list, that are the main points to make. On the commodity markets, which I haven't told you about yet, they're falling away basically as stock markets are falling away now. I mean, Merkel and Sarkozy, they're still speaking, so while they're speaking, expect markets to keep falling. So at the moment we've got copper prices down 1%, we've got crude oil down 1.7%, that's $86.35 a barrel, and our old mate gold, she's going up, safe haven status of course, up 1.5% at the moment, $1,784 an ounce for gold. The Aussie dollar's being hit by this increase in risk aversion that's coming through because of these European leaders making a mess of it again. Got a figure here for you, it's at 104.2 US cents for the Aussie at the moment. It did actually trade just above 105 today, but it's losing it now. Things to look forward to tomorrow in Australian time, or today Australian time if you're watching in Australia. We've got Westpac's leading index coming up. It's been running well below trend lately, and yet another indicator pointing to weakness in many parts of the Australian economy, and another reason, another piece of the evidence that we think will eventually add up to a strong case for the Reserve Bank to cut interest rates probably before the end of this year. And we're also going to get labour cost figures out too. So these are second quarter numbers. The labour market has been pretty tight, so there might be some strength in those numbers, but it's reflecting previous tightness in the labour market. Even now we're starting to see some evidence that the Australian jobs market is softening on some fronts. Okay, that's it for now. I'll be back tomorrow.